Hello, everyone, and welcome to Beyond the Noise, the M.M podcast where we explore the intersection between the investments industry and new technologies. I'm Andrea, and today I'll be your host. In this episode, we welcome Chris Acito, CEO of Gapstow Capital Partners, and together we'll explore a little bit how the industry has evolved from early days of institutional investing to today's tech-driven environment. We will discuss what experience, leadership, and adaptability mean in a rapidly changing financial world. Chris, thank you so much for being here today.
Andrea, it's my pleasure. Thank you.
Thank you. To start off the conversation, I'd like to really highlight how the industry has shifted and touch upon your experience and how you've seen that firsthand. Can you give us a brief overview of your background and experience?
Yeah, happy to do so. So I began life thinking I was going to become an economist. And so I went to graduate school in economics, but very quickly found that my interest really was in finance, not economics per se. And that parlayed itself into asset management. And so the mid-90s, and I'll point that out. First of all, that explains the gray hair, but also will give some context for some of the historical remarks, because that was a very interesting time for asset management. The first 10 years of my 30-year career was doing management consulting work. So strategic planning for asset management firms. That became my specialization pretty quickly, first at a large firm called Booz Allen and Hamilton. And then eventually I joined a couple of partners, John Casey and Kevin Quirk, to create a firm called Casey, Quirk and Acito, whose specialization was working just with asset management firms. And so, maybe my historical insights will come a little bit, especially at the time with working some of the leaders, particularly on the traditional side. Well, there really wasn't much alternatives, which I know we'll get into in a second. I then had an opportunity to help create an alternatives business for a private equity firm in the mid-2000s, and then had this interesting plan, I thought, in 2007 and 2008 to create an allocator based solely around the credit industry. And that's Gapstow Capital Partners. And that's been my seat for the last 16 years.
Well, very nice. And what first drew you into the investment world? You said you wanted to initially be an economist.
Yeah. Well, as I said, I realized that in studying economics, that a little bit more of my interest was really finance and the application of whether it was valuation, but also portfolio construction. And maybe to remember the time a little bit, as we may touch on in a moment, this was as the first round of factor analysis was really going from the academic literature into the practicing world, whether it would be BARA, as well as risk metrics, or early stages of Aladdin. This was the period of time in which this was all beginning to come to bear. I found that very, very interesting, and that led my interest in thinking about buy-side portfolio management and analysis.
And throughout all of this professional journey up until, since you began in the investment world until Gapstow Capital Partners, what would you say is a key turning point that shaped your professional journey?
My personal professional journey, I think really had two turning points. The first was in 1998, where after spending a little time at Booz Allen, I got the opportunity to work with John Casey, who, for the younger generation of listeners, he was a giant in the industry and really was at the forefront of helping create the institutional money management business as we knew it then and as we really know it today. And John was, quite a big figure, and allowed me kind of that first ability to step into the seat of working with senior leaders on the big strategic issues at the time. The second big turning point was the global financial crisis, because I had this interesting plan for a credit allocation business in 2007, 2008, thinking credit would be interesting. I mean, little did I know. Sometimes you get lucky in life where, the world takes a turn and suddenly the world's credit markets not only crack, but thankfully then began to heal themselves. And so Gapstow at the time was situated in the beginning part of 2009 as someone who could help lead the charge for allocators to say, actually, credit isn't just a broken asset, but actually this is the opportunity for maybe of a generation. I think it's played out that way to really, be at the forefront. We were at the forefront of helping people think about credit as an asset class and a meaningful portion of the portfolio overall.
Well, of course, there has been so many changes. And as you said, like a key turning point was as well the financial crisis. But regarding specifically the investment management industry, like what is the main difference as to how it looked like when you started as to how it is today?
When I was prepping for this, when I put it on paper, I knew it because I lived it, but it sounds so old. So this was 1995. It was, first of all, 60-40 was a real thing. I know we make fun of that today, but that was the dominant paradigm for portfolio allocation. Your fixed income manager was the most important person. And by the way, I'm taking the perspective of an institutional investor because this was the great age of institutional investing. So 20 years post in the U.S., pension reform and corporate and public pensions were really in their ascendancy in terms of asset accumulation, putting it to work, and growing enormously in that period of time. But the dominant paradigm, 60-40, fixed income, and your fixed income manager, he or she was probably your largest and most important relationship that you had. And your equities were all public. They were all active. People, believe it or not, still believed in active management at the time. And, alternatives really weren't much to speak of in 1995. I mean, there were a few PE deals being done. Hedge funds, a big hedge fund was $300 million. And, credit was that really didn't exist. I mean, some distressed credit, but nothing like the credit industry we took today. Okay, there was some real estate in a typical institutional portfolio, but, nothing like alternatives that we know it today. Oh, and by the way, too, we want to talk about client interfacing.
Yes.
We used to do this funny thing in 1995, which is we would fly to see our clients once a quarter. And then took like 3 days, but you did that and you went and saw them in person. The world was very, very different.
Today.
Exactly. And that must seem terribly different to you than what we're up to today.
And this is regarding the investment management industry. And we talked a little bit about market structure as well. But regarding like client expectations and more investment culture, what would you say are the big differences?
Yeah, well, client expectations were really just being formed at the time, in the sense that what people wanted in terms of reporting and how they wanted analysis presented to them, and analytics, and how frequently they wanted to have some interface. That was being still made up by the time in the early mid 1990s. But as I mentioned earlier, that was becoming more quantitative for sure. Mm-hmm. Again, BARA, risk metrics, Aladdin, people did start to begin to talk about the ability to, first of all, manage money in a more quantitative or scientific way, and the knowledge of where one took risks and how to attribute performance was becoming much more scientific. And so that began to be instilled not only within the portfolio construction world, sort of the best firms were, so to speak, quantamental, fundamental managers, but beginning to overlay and integrate quantitative methods within their methodologies. But that began then to creep into the reporting side of things, that clients wanted to be talked to in that way. In fact, an interesting anecdote from the time was that BARA, the risk firm, actually acquired John Casey's business, Rogers Casey, which was a pension consulting business, with the idea that through a pension consultant, Vara could help actually move that process along more quickly to use those institutional relationships to, I mean, in a self-serving way, get to know Vara factors in analytics, but it could have been other people's as well. That was really what was driving that, that small merger being indicative of the world coming around, understanding portfolio construction and reporting within that context.
Yeah, there's definitely shifting client expectations to more understanding, what's behind the portfolios, the why of shifting any parameters that are in there, and holding a better client relationship, even like a closer client relationship.
Correct, because clients understandably were becoming smarter. First of all, these were institutions. They were professional buyers. They were beginning to have staff. The pension consulting business was coming into place. And so, what went from an industry where mystique and personality drove flows and, assurances that I'm doing a good job, to that portfolio manager, he or she having to actually say, no, I can attribute why I performed in a certain way, was becoming much more the standard at that period of time.
And this is more regarding client expectations, but I'd really like to know, when and how did globalization, data, and technology start to transform the way you operated? I know it was gradual, and there are different types of technologies and data management and everything, but when did it start taking over?
Well, globalization was new. I mean, 1995 globalization from an investing standpoint was actually still pretty new.
Yeah.
And that came with not only a conceptual framework for why investing out of from a U.S. perspective, a non-U.S. company, but also the operational and mechanical aspects of investing efficiently overseas in Europe, let alone the emerging markets. Technology facilitated a good deal of that. Some of that trading technology, by the way, too. I think as you began to move post 90s into 2000s, began the birth of indexing. And ETFs. Those kind of go hand in hand to a great extent. And that was very technology driven, that ability to trade efficiently, to build and construct portfolios in a very time sensitive and risk controlled, measured relative to a benchmark. In this case, most cases, very tightly to a benchmark. That was facilitated by new computing power, new ways of interfacing between various parts within the value chain of portfolio management and construction. That was a big change that began to come in. So the risk metrics, the internet, remember that thing that began to be introduced in the late 90s and early 2000s, and that desire to obviously accumulate data and put things to work, and no longer having to receive floppy disks in the mail to do your update of the Vara system, but you actually did that now online. Things like that began really changing during that period.
Apart from globalization and then the internet, which people compare to today with AI, of course, that has almost become a buzzword nowadays.
Yep.
How is your view on technology today? How has it changed the modern investment process and decision making?
Yeah, well, to jump forward right to today, we'll skip over the 2000s and the 2010s. I think it's very relevant to jump into AI because that is, well, we'll touch on tokenization too, which I think is very interesting. But starting with AI, here's how I would characterize it in talking to a lot of money managers, which is still very, very early days. And perhaps when you ask people to summarize, they're a little surprised. I think perhaps the first idea was that AI would be applied obviously to the investment process, not just doing research, but really beginning to drive investment ideas. And actually that really hasn't come to fore right now. I think that original vision for practical and sort of existential issues, hasn't really fulfilled itself. AI is very creatively being applied to the investment process, but I think where people are finding it most impactful is in supporting human decision making.
Yeah,
that it's helping do not just rote tasks, but actually some value adding tasks, but ones which are allowing a portfolio manager, an analyst, a head of research to do their job much more efficiently when they come in the morning, that they can set up a program to download the 4 offering documents for new issues coming out this morning and very quickly triage where we should be spending time. But not yet, saying, well, you make the decision, Mr. AI bot.
I think there's AI can truly add value in some areas, but where does human judgment remain irreplaceable, right?
Well, and I think as a brief aside, because I want to talk to client service in a second. I mean, I think we're still grappling as an industry with what we know will become an existential question, which is as a fiduciary, somebody who's responsible for money, let alone my own, but perhaps in the role of somebody else's, at the head of an endowment, head of a pension, a wealth manager, at what point do I become comfortable with, the idea that an investment decision is largely being taken care of without any human guidance?
Yeah.
To throw back 25 years ago, as we've been talking about, when those quantitative models were beginning to be applied and people would say, well, why'd you make that decision? You'd say the quant model made this. At least you could say, and by the way, here's the code. Let's look into it and we can see. Maybe it didn't come out with the right answer, but actually at the heart of it, I kind of know because of the way I programmed it, why that decision was ultimately made. As we step into a world in which that won't be transparent, can a fiduciary get there? But, well, I shouldn't say that's a long way off. That's not a long way off. That's happening very, very quickly. I'm finding it interesting that in contrast to perhaps first expectations, AI, I think, is proving perhaps more value adding right away on the client facing side.
Definitely on the side of reporting, of cutting the time of portfolio managers to make all these
allocations, rebalancing portfolios, customizing according to the needs of individuals. Absolutely. And again, while I think that was always intellectually known, again, everybody assumed highest value adding, we got to put it on the investment side. This is really coming into the fore. I know for M.M, this is not lost on them. That's been an evolution that I think you guys have seen and not only benefited from, but learned to adapt a lot of your tools and techniques to helping people on constructing models and all the reporting things that you said to.
Definitely, yeah. Like as you said, the analytical AI has definitely been helpful for the rebalancing at scale, for constructing portfolios, but a big value add is the generative AI side that helps with the client facing to generate reports at scale, really helping portfolio managers have more time to focus on more important tasks than just writing down reports. Right. They can just carry more the human relationship,
Correct.
And
think of that client facing person who's not the portfolio manager. He or she gets to spend time.
Yeah.
Talking about, that those real planning aspects of what are going to be going into that client's needs, explaining, what's within a client portfolio, not just simply reporting, the opportunity to, go have a beer with that client instead of worrying about, whether or not the report is going to go out and have something insightful to say about people's expectations.
And of course, this is like a relatively new technology, like you said, so not everyone has fully integrated it. Sometimes it takes a new mentality of approaching innovation, these new technologies that keep on coming out. Well, throughout your years, you've personally experienced so many of these new innovations. How do you approach this new mentality towards a new technology, a new innovation in a field that is driven both by experience and by data?
Yep. Yeah, no, it's like everything. Change happens slower than you think, given what and I know it. I always find it. I'm often called into situations actually where a technologist and technology firm is trying to talk to an asset manager, and they just can't get on the same page because timing is different, and expectations around what can get done when and why, and technologists believing stuff is so evident that why won't it be done right away? And I think asset managers are, and this is probably no different than other industries, but I'll just say my experience with asset managers, I think the more successful ones at adopting AI have really pushed the thinking and strategizing about how to use it much further down the organizational chart, embedding people within individual investment teams, and helping them think about what can we automate next, as opposed to, I think, an approach maybe 5 years ago, which would have been, at the top level, we've created an AI group, and it's going to do work, and stuff will trickle down. And I don't think those experiences were as successful as when there is someone sitting on the desk and they're looking over at the head of research and she's doing something that involves shuffling papers or sorting through emails and can say, wait a second, how about we work on this next? And that gets some buy-in for more and more happening over time.
So really engaging the people within the company and having more of a bottom-up approach, you'd say?
I think so. I think that's been the evidence so far. Again, it's perhaps more anecdotal, but in a world in which top down. Again, we're going to live this throughout all of our industries and all aspects of our lives. When technology is promised from top down, people are dubious, partly because they're worried about what it means for them. They're also concerned that it won't understand what they do day to day. But when, in fact, somebody can walk in and say, you know what, I taught the AI bot to read the CLO offering documents and prospectuses, and it learned how I like to see the 6 major criteria, and to be able to move quickly when there's a bid list that comes out, for me to think about that. And if that's done at the bottom floor level with that portfolio manager analyst's input, suddenly they're realizing, this is actually making me more productive and more effective than it is, the top-down view, which might have been like, no, we're going to re-engineer the CLO investment process. And, just wait a year and then something will come out. That we laugh a little bit at that, but, I think that was the evolution a little bit on AI earlier on, and now it's changing. And obviously the tools have gotten much easier to use, so you can actually take that on at an individual group level, as opposed to having to make it. 5 years ago, people were still debating, do I develop my own, large language models, as opposed to buying something off the shelf.
That's a big question.
Right.
Even nowadays, make or buy. I think today has evolved towards like a hybrid of both. Like co-developing is very big right now, especially. But I think it's important to find that specialized tech partner, especially since there are so many today.
The technology just inherently makes sense and inherently should be adopted at some point. But for someone my age, it's an interesting question about, will it just be a generational thing? That is to say, for digital natives growing up today, the idea that you would, tokenize an investment in a real estate property is obvious. And in fact, they would think to that as the first way of potentially approaching that issue. Someone my age, you're having to convince them that something they know and are comfortable with should be replaced. And okay, you're probably right, but you know what? I'll wait till later for seeing it. So,
and regarding like these new technologies and innovations that we talked about, especially in this podcast and M.M, we know and we work with several institutions that maybe are trying to find a way to integrate these new technologies, new innovations, methods, but maybe aren't quite ready yet. What advice would you give them?
you're late. Get moving. And as I say, sometimes it's tough to. Who knows? Maybe someone who's a little late to the game is okay because you won't make some of the mistakes some of the earlier groups did. Make it grassroots. Make it start simple. Yeah. Just try some new things, begin to integrate it into the culture. But I think it's, do you need a tokenized version of every one of your funds right now? Probably not. Do you need to be having everybody on your shop floor at least rudimentary fluent in AI or ChatGPT or pick your favorite one? Of course you do. Right? Of course you do. Do you need to know how to program it yet into everything you do? No. Maybe not, but these are things small. that have to be done. I'm optimistic that people still feel that asset management is a very high value adding profession. Mm-hmm. And while perhaps ultimately everything is machine transferable, I think that won't happen for a while. And I think the ability of really good practitioners to want to just integrate this fully within their being processes. Every day at work, it's I think it's shifting from fear to actually, this is good. This is really good. This is really good.
To a necessity, maybe.
Yeah, I think some of the bigger challenges maybe are no longer, I'm afraid of my job as a portfolio manager. I do think the knock-on effects on personnel are not inconsequential. I think particularly when it comes to analysts, like what do I do with my young analysts today? It's a good question. Do I need more of them? Do I need fewer of them? Do they look different than before? Do I need any of them? But if I don't have any of them, where do senior analysts come from if I don't have junior analysts? So I don't mean to make it sound like it's an inconsequential impact on HR. But I think at least a large portion of at least the decision makers within asset management firms are on board.
I mean, it's funny. We were talking about this the other day, but I think with every new wave of innovation, be it like the internet, for example, they ask the same thing. Like, what are now the juniors going to do? Yep. It's not so about losing jobs, but maybe transforming them. Yep. Like, what new skills do they have to acquire nowadays in order to keep up, to have that competitive advantage?
Yeah. Yeah. There was a time in the 90s where an analyst spent their morning picking up all the faxes off the floor in the fax room to collate them to bring to their senior analysts. I mean, I think we all agreed that probably was a job that was okay to have disappear. Everyone was more happy about that. And, we have to remember those lessons. The speed at which this is taking off, I think, may be a little intimidating for some of us, but we've seen part of this movie before.
Yeah. Well, we've seen sort of how your professional journey has evolved and talked a little bit about the new waves of innovation and the industry throughout the years. Now, where do you see the industry heading today?
Yeah. So what are the big mega themes I see out there? I think no particular order. First of all, you will continue to see the alternatives revolution move forward. If we went from no alternatives 1995 to alternatives being mainstream to alternatives actually dominating portfolio theory today, you're going to continue to see that now as it's pushed through institutional, made its way through wealth to a great extent, and now the next 10 years will be pushing that out into retail. I'm actually not fully convinced that will happen in a way that we've thought about. And, maybe there are going to be some limiting returns to how much capital we can put in these alternative spaces, which for 20 years was pitched as niche opportunities that, get in because, only a few people can get into certain activities. There may be some limit, or at least at these fee levels, be that as it may. The concept of wanting to integrate into your portfolio things other than long only bonds and equities is moving fully out now to retail as opposed to wealth, but also retirement as we know it. In the capital markets, we're going to continue to see risk from bank balance sheets get transferred to insurance balance sheets and to private funds. That will fuel the growth of some of the alternatives and risks being spread around the environment in a much different way, which I think has pretty profound implications for monetary policy and for savings and all sorts of other things. And lastly, just to reiterate, I think we're still so early on AI.
Yeah.
We won't even. I don't think we don't know what we don't know yet in terms of what's coming in the next. 10 years seems crazy far away. For AI,
Yes.
we're still guessing at the next 2 to 3 years as it's coming along. But those will continue to be the strength. Maybe to take it full circle, what's interesting is you're actually seeing the diminution these days of corporate and public pension plans. Corporate being first, a lot of them actually going away or freezing their pensions, and publics, to some extent, peaking out as well. So it's a brave new individual investor world looking forward as well.
Well, and not only is the investment management industry adapting to this new technology, but how would you say it is adapting to these new generations and new set of expectations?
Absolutely. Look, I think it's, again, coming back to my comments about a digital native, if you're 18 years old today and the idea that you have you grew up with a Robinhood account and maybe some stonks that you've owned over time, but you have stable coin and you don't go to a bank and you've never physically held a credit card, right? The world is very, very different already for those of us of my age. And so, that generation, I think, are ones that are be like, fund document. No, I do this by token, right? Money market mutual fund. I've got a stable coin. Changes to my portfolio. I don't, call up somebody. I forget about doing it on my phone. My bot knows exactly how do I want to rebalance in these certain situations. That all runs through, which is, in a world, and it's being done on a customized basis for me. So, I have to remind myself just how much of this is already in place. It's not 5 and 10 years down the road, but I think a lot of the technologies we've talked about just grow in importance as a younger generation just comes in, for which this is just the way of being.
Yeah. And to start wrapping up today's conversation, I would like to end with, what broader industry trends would you say are shaping the next era of investment management?
Yeah, we touched on a lot of them. As I say, I think, tokenization, AI implementation, continued worlds into alt, mass customization, all of those just go from being cutting edge technologies to just the way people do their business.
Yeah.
And, perhaps more interesting is who are the big money managers of the future? Are they stablecoin issuers who get into other variations of investment management products? Is it the alternative firms? Or actually, is it the resurgence of traditional firms? Because they know how to work with retirement plans and with individual investors, where alternative managers maybe don't have those relationships and abilities to market products. I think the product trends in some ways are perhaps easier to discern than who exactly the winners from an asset management company are going to be. So 10 years from now, there are going to be people that we don't even know exist today who are taking a big part of the paid for investment management services. A couple people will still survive, but it's what's exciting is we know there are people that we don't even have on our radar screen right now.
Okay. Perfect. I think this is a good point to wrap up our conversation. And well, thank you so much, Chris.
You're welcome.
And to our viewers of Beyond the Noise, if you have any more questions, you can visit www.m.m.ai where you can get in touch with us. Thank you so much for tuning into today's episode. Thank you so much, Chris,
You're welcome.
for joining us. This was Beyond the Noise, and see you next episode.